I just want to explore the extent to which global debt vulnerabilities are a risk to financial stability, if I may. What do you say to the charge that central banks globally have been behind the curve when it comes to combating inflation, behind the curve from an interest rate policy point of view? And that, in effect, has not just meant that inflation has risen to the levels it has now, but low interest rates encourage debt. So we have a situation of rising debt, rising inflation, which surely cannot help financial stability, can it?
Well, we obviously went through quite a long period of low inflation when, in many ways, central banks were trying to stabilise inflation upwards rather than downwards, which is obviously different from, historically speaking. And that was a period where QE was used.
If I may say, sorry, Andrew, if I may say, there was a long period when interest rates remained very low relative to inflation. Clear signs of inflation ticking up. They didn't suddenly jump to 2 or 3% up to 10 or 11. But still, central banks, not just the Bank of England, but central banks were well behind the curve. Now, this has encouraged rising inflation and high debt levels. So I don't take your point that there was there was a long period of low inflation, but interest rates, when inflation did start ticking up, interest rates stayed pretty stable for a long time and ignored all the siren warnings about inflation, and then is now playing catch up.
Well, actually, it wasn't that long a period, if you don't mind me saying so. I mean, we had the COVID period, and then we've had 18 months or so, I would say, of coming out of COVID, 2 years at most. So it wasn't that long a period, if you don't mind me saying so. I mean, I think when I look back on that period, I mean, let me say, I think we've had a number of shocks that have affected the world economy, which have contributed to, if you like, the pattern and pace of adjustment. And the shocks that I would draw out, the big ones globally, have been what we tend to call the global supply chain shock, which was the sort of coming out of COVID shock. That really reached its peak a year ago, I would say, and has been declining since then, and probably declining at a more rapid pace as last year went on. And we see that in trading goods prices and shipping costs and other things. The second and the much bigger one, obviously, has been the tragic war in Ukraine, which has had a huge impact, if you don't mind.
Before the supply side shocks, or the global supply chain shocks, and even Ukraine, there were clear signals, for example, money supply figures going through the roof. There were clear signals of pockets of inflation around the place. There were no shortage of economists warning that inflation was there, it was coming round the corner in some measure. And yet banks still kept, Bank of England included, interest rates very subdued. Now I raise this because that encouraged high debt. Because when interest rates are low, people take on debt. It's a natural phenomenon. And we have a situation now where we have debt levels still going through the roof, very high by historical standards. We have inflation, we all know, 10, 11%. That cannot be good for financial stability. And I suppose I'm not just laying it at the Bank of England's door, I'm laying it at central banks generally, that have you been sleeping on the job?
Well, QE was used during the COVID period, in my view. It was very well set out by Ben Bernanke in his recent book, actually, to stabilise rates further along the curve, and particularly to stabilise rates for corporate borrowers during the COVID period to help them deal with the shock of COVID. And I think that had a beneficial effect.
Can I just push back even further? To what extent has the policy, because there is a view that this policy of ultra-low, artificially low interest rates has been a deliberate policy, because in the absence of growth, the best way of eroding debt levels is to encourage inflation. Now, I don't expect you to agree to that.
No.
But I don't expect you to say this is what the policy was. But if you look at how it played out, there was a theory that, how is it that central banks can allow inflation to jump to 10, 11%, when they had most of the tools at their disposal? But it is a little convenient, isn't it, that when you've got inflation at that level, debt gets eroded pretty quickly.
Can I push back on that? Because I'm afraid the biggest single reason that inflation has risen to that level is the war in Ukraine. And it is also the most likely reason that we're going to see a rapid fall in inflation in the year ahead, because we are not seeing energy prices rising further. In fact, they're coming down.
History would suggest that once inflation exceeds 5%, it takes many years to get it down to around 2%. Now, I know there are these forecasts saying that it's going to halve, but history wouldn't suggest that's going to happen. Because once inflation gets endemic into the system, it gets built into wage claims and everything else, and expectations rise. Am I being unfair?
Well, we're in danger of having a March policy hearing, but let me make one point. I think that going forwards, the major risk to inflation coming down in the way that I think it otherwise, in my central cases it will, is the supply side, and in this country particularly the question of the shrinkage of the labour force, which is what really... Now, can I just make one point? I am afraid I do not remember people saying during this period when we were coming out of COVID, and particularly while we were still in the furlough scheme, which we were until end of September 2021, got the year right, you know what, the labour force is going to shrink in this country. I really don't remember people saying that.
We're going to have to agree to disagree on
well, we should continue the debate. We've got another hearing next month.
Let's move on a little bit. Ultra-low interest rates, certainly relative to inflation, there has been a misallocation of capital to a large extent. I mean, for example, something like, some estimates suggest 10 to 15% of companies in the US are so-called zombie companies. In other words, if interest rates were to rise much more, you'd have a lot falling out of the system. Now, that would be a danger to financial stability. To what extent do you subscribe to that view? This misallocation of capital, one example being zombie companies.
I don't particularly subscribe to a more structural view of it. I think one of the things that we do look for, and I think this is more of a risk in the US than elsewhere, is the risk that comes from excessive leverage lending, which creates more leverage in the corporate sector. It's something that we've been highlighting for some years now, actually, and I think need to be more focused than ever probably on. The numbers would suggest it's more of a US, I think, John, you believe, a US phenomenon than it is certainly a UK phenomenon.
Okay. Moving on to the broader picture, we've got high inflation that some of us believe think is going to be stickier than certainly central bank forecasts. You've got eye-watering debt levels, not just in this country but globally. Where do they fit in on the risk profile with regards to other threats to financial stability in this country? And may I ask you to include the deteriorating economic situation in China in that list? Where does high debt, high inflation, China, and any other threats you think? Give us some sort of general view as to where the dangers are.
Well, I think we do have to have a very close eye on, debt levels in this country. Going back to what I was saying earlier, the answer's a bit mixed, frankly. So both corporate and household debt levels are still below where they were pre-global financial crisis, but we are, as I said earlier, in a period of rising rates, so we have to be. Now, on the corporate side, I would say in this country the evidence is that the debt level is rising more in small firms than it is in large firms, so again we have to be focused on that. I've just mentioned leverage lending, which I think is more of a US phenomenon than it is a UK phenomenon. As far as China is concerned, yes, we do have a very close watch on that, not least because, obviously, as you'll know, our financial system is more exposed there because of the historical connection than other systems are, which is why in all the stress tests we do of our banks, which we're doing one, some others are doing one at the moment, we have to put in give a lot of thought to the China shock that we put in there because of the impact it will have. What I would say about China at the moment, in my view, is first of all, in the sort of the economic outlook, I think it's quite likely we will see a negative impact in the short run on China from what's going on at the moment in terms of the release of the COVID restrictions and the impact that's having. I'm not sure that will be very long lasting, though. I suspect they will come through that. I think then how they manage credit in the system is important. My sense is, the property sector, I think, continues to be under stress, but they are managing the supply of credit into it. But we have to, you're right, we do have to keep a very close watch on that. And I'm afraid the other one is, obviously, we're still living in very, difficult conditions, given, obviously, the potential for any further impact from the war in Ukraine.